Now, the benchmark interest rate known as monetary policy rate, it's indeed a big one. We've been talking about this since Tuesday because the Apex Bank retained 27%, that's for MPR, by the Central Bank of Nigeria. This information was revealed by the governor of the Central Bank, Mr. Olayemi Cardoso, while addressing newsmen after the Monetary Policy Committee meeting in Abuja. Members of the team deliberated on different macroeconomic indices and decided to leave the rates intact for another period. At the last meeting in September, the interest rate was sliced by 50 basis points, or 0.50% to 27%. Data released recently by the National Bureau of Statistics shows that inflation further eased to 16.01% in October 2025, and for the MPC, tampering with the MPR at the moment was not advisable. They agreed to maintain a tight monetary stance for now to further rein in inflation and stabilize the foreign exchange market. Also, the MPC agreed to keep the cash reserve ratio at 45% for commercial banks, 16% for merchant banks, 75% for non-TSA public sector deposits. In addition, the liquidity ratio was retained at 30%, while the standing facilities corridor was adjusted to positive 50 to negative 450 basis points around the MPR. My guest is the Chief Executive Officer of Financial Derivatives Company Limited, Mr. Bismarck Rewane. He joins me for this conversation today while we make sense of the outcome of that meeting. Good afternoon, Mr. Rewane, and it's so good to have you on TVC Business Nigeria.
Okay.
Good afternoon. Can you hear me, Mr. Rewane? Okay, I can hear you. Can you hear me?
I can hear you clearly.
Thank you so much for your time. Now, let me say, what will be your reaction first to the move by the Apex Bank to retain the MPR rates, considering the fact that inflation has continued to decline?
I think that the way to look at it is that the policymaker is taking a forward view and is basically telling the markets that anticipated inflation is more important than historical inflation. The two, that the imponderables and things that are outside Nigeria's control are probably more than the things within our control. So let's face it. What the central bank is saying that, yes, we know historically the trend is down. Historically, the inflation is moderating, and historically, money supply growth is moderating. But if we were to take a forward-looking view and say, for example, think what could happen to the price of oil, what could happen to our international flows of funds, and what could happen to the global commodity markets, it's possible that anything could change. So what they've done is to take an anticipatory view and an anticipatory stance, knowing the difference between financial monetary conditions and monetary policy, and therefore taking a very, very aggressive stance in holding the rope. What they have done essentially is to say, we believe that we've made some progress, but there's still some work to be done. And therefore, what we do know is that the inflation numbers for November will be coming out in December, and inflation numbers for December will be coming out in January. Then the rebasing effect, which had helped us moderate inflation in the past 2 months, will kick in the opposite direction. So to that extent, if we have the opinion that inflation could go back up to 18 or 19%, just in terms of methodology, then let us take a position and wait for the fundamentals that determine 1, the rate of inflation, 2, the money supply, and 3, the exchange rate. Let us see that and take it all together and take it holistically. That is why the next meeting of the MPC is in February. So we have 3 months on which to tidy up things and ensure that the gains of the past and the policy benefits of the decisions that were made in the last 2-3 months, we can see them materialize and reduce the lags between policy decision and policy impact.
I also like your reaction to the decision to adjust the standing facilities corridor, which is also to enhance liquidity. Is that also a step in the right direction?
Yes, it is. What we are saying is that the money supply growth is tapering, and we've seen it actually increase marginally to 10.76%. But what is important is that the banks are making money just by leaving it at the central bank, in the central bank window. Before, they used to go and borrow from there. Now they have excess liquidity and they're putting money there. So to encourage them and to incentivize them to actually lend to the real sector, what the policymakers are doing is reducing the return you make by just leaving money on your account at the central bank to now actually lending money to the real sector and sectors that can create jobs and increase corporate profitability. So it's a good thing from that perspective in terms of making money work for itself. But you want to look at it holistically. One, there are fiscal programs which have to do with revenue, tax, budget, and debt. And there's monetary policy which has to do with price stability and system-wide safeness and soundness of the financial system. What the central bank has done this time, and the Monetary Policy Committee implication, is to say, look, we know that in December there will be a budget for 2026. We do know that we are going into a year where there will be a lot of economic activity and political activity. Therefore, we are taking an anticipatory stance to mop up liquidity, tighten things before the deluge and the whole surge of political spending takes off. But on the other hand, we want to encourage the banks who have most of them met the capital requirements to go ahead and begin to lend money and make money work for themselves, make money work to the benefit of the economy and having a multiplier effect of these investments as they go along, rather than keeping idle money and money stranded is actually having a negative multiplier effect.
Now, the CBN, according to analysts, many analysts have said the CBN is doing its best. We've seen stability even in the foreign exchange market, that disparity that we used to talk about before now. Now, it's almost the same as the bank exchange rate and, of course, on the other side of the market. But the fiscal side definitely has a role. So many are asking, and my question really would be, do you think the Apex Bank is doing enough? What more can be done to support an economy that is coming out from the reforms embarked on by the administration of President Bola Ahmed Tinubu?
No, I think the way to look at it is that are the goals, fiscal goals and monetary goals aligned? The answer is yes. If they are aligned, what is the priority at this point in time relative to the other? I think it's quite clear that if you allow the currency to go wild because you've saturated the system with money supply, if you allow the currency to go into volatility because the foreign exchange market is less than transparent, then all the gains or all the political objectives will be lost because of mismanagement and recklessness of in the monetary policy space. So, to be honest with you, I believe as an economist, I believe strongly too, as an investor, that the central bank is doing more than is even required to have stability. Because you remember that the Central Bank of Nigeria has made it clear, even in the past, that any inflation rate above 13% is growth retarding. The central bank has said before that anytime we have FAC, we notice some weakness in the currency. Every time there's excess liquidity in the system, it also leads to some irrational exuberance. And so the central bank governor said in a response to a question that the intervention by the government, total intervention historically has come to about 14 trillion naira. Only 10 trillion naira has been recovered in terms of loan repayment. So there's 4 trillion naira lying fallow or wasted or in negative activities. So what we are trying to see, what we are seeing is sanitization of the intervention market, right? Without hamstringing the development financial institution like the BOI, BOA, and others. Ensuring that the transparency in the currency markets, which has been manifested by the efficient market hypothesis, that when variables are aligned or are aligned, you will see that that currency is stable. After stability comes confidence and appreciation. We are beginning to see that. Thirdly, we have seen that because of this stability and confidence, we are seeing that the front loading of demand for foreign exchange, which was what was happening in prior years, has slowed. So what are we going to see in December 2025? One, because of visiting friends and relatives, we are going to see the Naira appreciate. Two, because that's the main crop of the cocoa season, we'll see some of the export proceeds coming. Three, because there's going to be some investment in the upstream, both in deep offshore and deep water and the offshore, we are going to see some money coming. That is exploration money coming in. And four, because of the clampdown on activities of bunkers, we are going to see oil theft reduced. When you put all of this together, it gives you only one outcome. It gives you the outcome that the currency becomes stable and appreciated. Then, on the fiscal side, we would see that because the Dangote refinery, which is a game changer for us, is going to actually increase their production, one. Two, it's going to actually bring prices down, and you'll see that going to happen very shortly. So when you have the price of PMS and price of diesel coming down, and you have a currency that is stable and appreciating, generally speaking, the economic fortunes of the country begins to improve. I think that's the way to look at it. Now the problem is that how do you translate and how do you convert this monetary policy accomplishments to the welfare of the people? That's the challenge. How does the fiscal authorities, how do they carry out this unconditional cash transfers? How do they ensure that investors bring in more money at this time, irrespective of what's happening? If we have all of this happening, then one can say the next 2-3 months we're begin to see some appreciable gains, which are tangible and people can see it. And that will be, you would have both the economic, but also the economic dividends and political dividends at the same time.
We really wait so much for that time. Now, almost the tax laws are expected to come into effect in January 2025. I would like you to also react to this, particularly proper implementation. We saw what happened with the capital gains tax and the reaction of the stock market immediately that came on, and the minister had to say, we're going to revisit this and come back to you. I'd like you to react to that, Mr. Rewane.
One is a message. Two is the messaging and the form of communication. And three is the level of understanding and sophistication of the market. What the tax reviews are extremely positive from a macroeconomic perspective, public finance perspective. However, the audience have to understand it in the context in which it is done. Two. Three, the timing of this reform. All we need to do, in my own judgment, is to say, look, we are going to, the implementation date for the whatever it is, the capital gains tax, is going to be deferred for the next 3 months or so that the market can understand and absorb it. In any case, the federal government of Nigeria, who announced on the implementation of a 15% import duty on refined products, said, okay, because of Christmas, because of its possible negative effects, we are delaying the implementation of this 15% tax so that we don't have queues during the Christmas. And so if the same fiscal authorities could do this, the same fiscal authorities could and should go back to the market and say, look, we know this, we know what we're trying to do is good, but the timing of it, because of the misunderstanding and to demystify the whole idea of capital gains tax and people selling shares, we are going to move it forward to April 1, by which time the communication will be better and the message will be clear, very clear, and there'll be clarity and understanding of it. If that happens, I think that will give us some breathing space to do the right thing. And also the comparison of Egypt and other countries, South Africa, where capital gains tax, it does not take into consideration many things. So I listened to Mr. Oyedele yesterday, and it was very clear the benefits were, to me, as a sophisticated investor, I understood it. But to the ordinary man, the widows and orphans out there, I think we need some time. So my advice at this time is to delay or postpone the implementation for maybe 2 to 3 months, maybe 1st of March or 1st of April, and then have enough time to recalibrate and make sure that it's understood, and therefore the benefits will actually accrue to the people. So I will not panic because of the overselling of the market. In any case, the market had gained 45% before this sale. So we had gone all the way to 97, 98 trillion. Now we're at about 90 trillion. What will happen is that some of the profits that were made before will now have been given back. But I think the market will recover. There's always a Santa Claus rally. Hopefully the price of oil stays at about $60 to $62 a barrel. And that way, Nigerian investors, both domestic and international, both foreign portfolio and foreign direct investors, will catch their breaths and begin to bring money back into the market. The last thing we need now is a precipitous sell-off and what we call a dead cat bounce.
Finally, now, before I let you go, Mr. Rewane, we are expecting the Santa Claus rally, really. We really want to take advantage of that. But the issue of insecurity in some parts of the country, some would say it could impact the larger economy and, of course, the entire expectations and fallout of these reforms and efforts by government so that it doesn't just make nonsense of it. Now, what do you make of the impact of that and, of course, efforts of government?
Well, insecurity is what we need least at this time. Insecurity has an effect, one, of making investors nervous.
Yeah.
But also, it also leads to higher cost of moving goods from the farms to the markets, from urban and rural. Inflation the dichotomy gets distorted. So we need to deal with insecurity holistically, strategically, and tactically. So you respond to it, you anticipate it, and do a lot of things. Insecurity is not going to be solved in one day. And therefore, it becomes part of our natural habitat, if I may say that. I don't think that, first of all, there's initial panic reaction, but after that, we'll get our way around it. One of the things to look at, I can tell you that from Lagos to Abuja by air, return is about 400,000. From Lagos to Warri, which is where I come from, return now is about 550,000 naira. Why? Because the likelihood of being kidnapped for insecurity and all of that in the Niger Delta is probably higher than the likelihood of being kidnapped in Abuja. So the markets have priced in a risk premium of traveling. That is for the individual. I want you to consider what happens for the goods, what happens to the roads and all of that. So it is a major constraint to growth, a major constraint to investment. And there's only so much the central bank can do. There's only so much that fiscal authorities can do. The security architecture of this country is in the hands of the military, the police, and the whatever they call the security infrastructure. That cannot be solved overnight, but we have to show that we are serious about it. And it's not just another thing that will just pass away. But I wanted to make a comment before I go about what has happened as far as the Monetary Policy Committee is concerned, both in Nigeria and Ghana. In Nigeria, we kept rates steady, which was a good thing. In Ghana, the following day, the Ghanaians cut their interest rates by 350 basis points, in addition to the 650 earlier. What has happened? Nigerian currency is considered highly undervalued, which has a lot of upside potential. The Ghanaian currency is considered overvalued, and therefore it is vulnerable. So, but the way to look at it is that the Nigerian economy is underpinned by oil, and the price of oil is coming down. The Ghanaian economy is underpinned by gold, and the price of gold is going up. So, like we say, different strokes for different folks, and that's the way we look at it. Thank you.
Thank you so much, Mr. Bismarck Rewane. Thanks for joining us, Chief Executive Officer, Financial Derivatives Company Limited. Do have a great weekend. Hope to see you again soon.
Thank you for having me.
All right, then.